Welcome back. Well, in light of a number of different housing market numbers have been released recently, I thought it might be helpful to take a review and see where our housing market sits. Now, we'll look at a number of different slides. The correlations and the relationships hold steady, meaning that one chart is going to look very, very similar to another. The housing market is a very consistent market to watch. These numbers are very closely linked together. We see here in red the XHB. That's the S&P 500 ETF that represents the housing market, the home builder stocks. And we see here in purple the sales price for single family homes. Now, this is a chart, this is the pattern we're going to see over and over again. We hit highs May, June of last year, 420,000. That was the single family home sales price. That precipitously dropped down to around January of this year, 365,000, and then bounced back to the upside, now 380,000. The question we have to ask ourselves ultimately is this a reversal in the trend, or is this just what traders might refer to as a dead cat bounce, meaning a bounce up in lieu of a long-term trend to the downside, and in the future we'd probably expect lower lows? That's the question we have to ask ourselves. Now, obviously as single-family homes, their sales price goes up, home builders make more money, we'd expect this red line, the XHB, also to go up. We see here in red XHB, and the green line represents the median sales price of existing homes here. Again, hit very significant highs July, August of last year. That was around 414,000, and now has achieved new lows at 366, which is actually kind of interesting because if we see the prior slide again, we saw a bounce in the single family home sales price, but the existing homes we're not seeing a bounce, at least as of yet. Existing home sales and single-family homes are plotted above the federal funds rate, which is shown in yellow. Obviously, higher interest rates are a negative for the housing market, and as the Federal Reserve has raised rates very aggressively since last year, we see these numbers have continued to go down. Now, the question is, does this represent the reversal of a trend? Well, the Federal Reserve, we know, is probably closer to ending their interest rate tightening cycle, but I don't think they're anywhere near starting to lower rates. So why are these numbers bouncing? Is it a temporary bounce, or is this truly a reversal in the trend? By the way, also, we'll notice May, June of last year, that was the turning point for a lot of these lines. For those of you that have watched some of our other videos talking about the bond market, you'll remember this coincides with the beginning of the inverted bond market, when the 1-year bond crossed above the 10-year. Funny coincidence that these numbers turned just as the bond market inverted. Take a look at here, the XHB, the Home Builder Index, in red against the federal funds in black. Higher interest rates certainly are a negative to those home builder stocks. We see here the correlation. This is the monthly supply of homes compared to the XHB, and it looks very much like an inverse correlation, meaning the more homes that are on the market for sale weighs on each home, and then obviously the prices have to come down and the home builder stocks move accordingly. This is the correlation between the XHB and the existing home sales housing inventory. Again, it's not a perfect correlation, but they do tend to move in opposite directions. We see here, this represents the median days on the markets that a property lists for in a given geography. Now, specifically, we're looking at the correlations between the XHB, the Home Builder Index, and the different economic numbers. So if you ever wondered which economic number probably most closely tracks with the home builder stocks, well, this is what we've discovered through the data. The affordability index is at 82% positive correlation. A 100% correlation is a perfect relationship, but the data does suggest that as affordability index, and that's measured on a scale of 100, if it's above 100, the average family can afford more than the average home. Less than 100, that's a negative. That is the most accurate or the most closely linked economic report that we watch that correlates to the XHB, the housing numbers. The closest negative correlation that moves in the opposite direction are the existing home sales monthly supply at a 73% negative correlation. Also, the housing inventory, the active listings at a negative 68% correlation. So if you trade the home builder stocks, or you're trying to get a read as far as which way they would go, check out the housing inventory numbers, the active listings that we talk about here, the existing home sales, and the affordability index. Now, we can see here in red the XHB, in black the housing inventory, the median days on the market that a house will sit. And obviously, the greater amount of days a house will sit on the market before it's sold is a negative for the overall market. We can see that hit a pretty significant high of 74 days in the market and is now back to the downside. The question is, well, if this is going down, does this mean that the XHB is going to go up? Does this mean that maybe we're at the bottom of a turn? Some of these numbers are a little bit more sensitive to the anticipation of the end of interest rates, but this is one turn. I don't know that this necessarily represents a big turn in terms of the trend. And then finally, we see here the orange histogram bars are the federal funds rate, the upper bracket at around 5%. And the black line represents the housing inventory. Again, the median days in the market a home will sit. We've seen a big reversal, but the orange bars remind us that the Federal Reserve has not completed raising interest rates, or at least not reverse course. And that the bond market, we talked about this in a couple of videos prior, that the 1 month bond has really taken a turn to the downside. Maybe that's an early signal that the Federal Reserve is done raising rates, or will be done in the near-term future. But then again, that does not necessarily mean that the housing market is on its way to a recovery. Housing market is dependent on low interest rates, and we don't have the Federal Reserve talking about lower interest rates anytime soon. Of course, the market's a forward-looking mechanism, but nevertheless, while rates persist up here in the 5% region, I can't imagine that that's very good for the overall industry. But we're going to continue to watch these numbers very closely, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.